What's up, y'all? My name is Kenyatta. If you've been feeling kind of in the dark about everything that's been going on around this conversation about stocks and investing, you're definitely not alone. In this video, I'm going to explain the fundamentals of stocks and investing so that you can have a better understanding and have a good foundation to go off of if you decide to actually start investing. I'm going to touch on a bunch of different topics in this video, so I will leave timestamps down below in the description. So if you're interested in a specific topic, you can just skip ahead to that section. Before we get started, I want to ask you guys to please hit the like button and also please subscribe. Okay, let's get into it. So the first question I feel like we need to get out of the way is, what is investing? Investing is basically when you buy an asset that you expect to go up in value over time and provide some sort of returns in the form of income payments or capital gains. I want to break this down into more simple terms. So an asset is something that has value or that can be used to produce value, as opposed to a liability, which doesn't have much value or is costing you money over time instead of making you money over time. For example, I own a rental property and I'm able to collect the rent monthly, meaning that this property is returning income payments to me. That property is also increasing in value over time, so if I do decide to sell at some point, I will make a profit, meaning it will provide a return of capital gains. Capital gains is the profit received from the sale of an asset. Because of these things, my property is an asset, and when I bought it, I was making an investment. I also own a car, which unlike my rental property, only decreases in value over time. So if I do decide to sell, I won't make a profit because I'll be selling for less than I bought it for. I will also have to continue to put money into the car as it gets older, meaning I'll be spending money, not making money. So because of these things, my car is a liability, and when I bought it, I was not investing. Okay, so now that we've defined what assets are and what investing is, we can get into stocks. A stock is an asset that allows you to buy shares of ownership into a company. For example, Disney is a company that has its ownership in stock, which is broken up into more than 1.8 billion shares. The people that own the majority of that company own majority of the shares. I own one share of Disney, which means I own a very tiny sliver of Disney's company. Next, let's talk about dividends. Dividends are payments made by a company to its shareholders. So remember earlier I mentioned that assets can provide a return of capital gains, which would be if you bought a stock for $10 a share and then made a profit after selling it for $13 a share. Or assets can provide a return of income payments, which would be equivalent to receiving dividend payments just because you own a share of a stock. Not all stocks pay dividends, but lots of well-known, safe to invest in companies do. When you research a stock, you will typically see a number called the dividend yield. That shows how much a company pays in dividends each year relative to the price of its stock. So for example, if a stock costs $100 per share and it had a dividend yield of 4%, if you owned one share of that stock, you would receive $4 per year in dividend payments. Now that may not seem like much, but when you consider the fact that inflation is going to decrease the value of your money by 1 to 2% every year, it starts to make more sense. If I was saving $20,000 under my mattress, it would be losing 2% a year. Remember when $1 could buy 4 bags of chips, and now that same $1 buys like 2 bags of chips? Yeah, that's inflation. So if I invest my $20,000 into a stock that costs $100 per share and had a 4% dividend yield, my money would increase by $800 in that first year alone. That would help me keep up with inflation and make a little bit more on top of that. Let's go a step further into stocks and talk about mutual funds. A mutual fund allows you to invest in a bunch of different assets at once, all within one fund. Simply put, you can buy one share of a mutual fund, which essentially bought you a little piece of everything that's wrapped up within that fund. Mutual funds are a great way to diversify because if you put all your money into one stock and that stock has a bad year, then you're going to lose most of your money, most of your investment. But if you invest in a mutual fund that has, say for example, 20 stocks, you wouldn't lose all of your investment if one of those companies had a bad year. The other 19 stocks would carry the investment forward. A lot of us are actually invested in mutual funds and we don't even know it. Typically, when employers offer retirement accounts, most people aren't active about what investments they make within that account. They typically pick a target date fund and then just never look at it again. These types of mutual funds are usually actively managed by a professional, so they charge fees, which can sometimes start to eat into your profits. A different type of mutual fund that is not actively managed by a real person is an index fund. Index funds are mutual funds in that investing in a single index fund means that you're investing in a bunch of different things contained within that fund. However, instead of being actively managed by a professional who will pick what goes into that fund, index funds are built to track a certain index. So for example, a fund that tracks the S&P 500 is automatically going to include the same 500 large companies that are included in the S&P 500 index. There are a bunch of different indexes out there, but the S&P 500 is one of the most popular. It typically returns about 7% per year on average, which it has been doing for decades. Index funds are perfect for beginners because as far as stocks go, they are relatively low in risk and relatively consistent as well. Speaking of risk, it's important to assess the risk before you decide to throw your money into something that you think is an asset. The book, The Intelligent Investor, endorsed by Warren Buffett, arguably the greatest investor in history, talks about the difference between investing and speculating being the amount of risk involved. Typically, investors are looking to make decent returns by taking on average to below average amounts of risk, while speculators are looking to make abnormally high return by making risky bets that can either go one way or the other. So I made this mistake when I lost all of my savings investing in cryptocurrency years ago before I had ever heard of the concept of investing versus speculating. In hindsight, I can see now that that was a speculation, not an investment. If you're curious about exactly what happened with that whole thing, I made a video about it, so I will leave a link to it up in the atmosphere somewhere. You can check it out if you want to. It's okay to speculate every now and then if you know what you're doing and you can afford to lose everything you put in. If that's not the case for you, you're better off investing in a safe and steady index fund. If you're ready to start investing, you'll need a brokerage account. A brokerage account allows you to place trades on different assets like stocks and mutual funds. There are a ton of different brokerage accounts out there. I personally use Fidelity and I don't really have any problems with them, so I would recommend them to anybody else who's trying to get started. Opening a brokerage account is pretty easy and you can typically do it right from your phone or from your computer. They're going to ask you some personal info like your name, social number, income level. They may even ask you to snap a pic of your ID and upload it so that they can verify your identity. It will probably take a couple business days to approve, but once it's done, you can go ahead and link your bank account, transfer some money over, and start investing. So that's an overview of investing. If y'all have any questions or want any clarification about anything I've mentioned in this video, go ahead and drop them in the comments and I'll do my best to help out. Hopefully this info was valuable and it helps you as you begin your investing journey. If you feel like you got something out of this video, please hit the like button for me and also please subscribe so you don't miss future videos on different financial topics. Also, go ahead and share this video with anybody who also wants to get into investing and needs a good overview. Thanks for watching, y'all. Peace.